As we navigate the opening chapters of 2026, a fundamental friction is beginning to dissolve within the global economic consciousness. For generations, the old-style paradigm dictated that debt was the essential fuel for personal and national progress, a necessary heavy weight to carry in exchange for participation in the modern dream. We were taught to view borrowing not as a last resort, but as the primary vehicle for upward mobility. However, this reliance on future liabilities has created a systemic stagnation. From a macroeconomic perspective, it has over-leveraged nations. From a microeconomic perspective, it has trapped millions of households in a cycle where they are working not for their own growth, but to service the ghosts of their past consumption. At world perspective, we recognise that a profound re-engineering is underway. The world is moving beyond the cycle of perpetual borrowing and toward a model of sovereign equity. This is not merely a financial adjustment, it is a complex liberation of human intellect, time, and creative potential. By demystifying the mechanics of capital and providing accessible, data-driven solutions, we explore how society is pivoting from a life of liability to a future of true, unencumbered freedom. 1. Deconstructing the consumer debt trap, from friction to financial literacy. The contemporary retail landscape is engineered to bypass our rational intellect. The proliferation of frictionless borrowing, from ubiquitous subscription models to the highly sophisticated buy now, pay later algorithms, preys upon our psychological bias for instant gratification. When credit is invisible at the point of sale, the cognitive weight of the purchase is deferred. This environment has cultivated a culture where future earnings are cannibalized before they are even realized, creating a state of permanent fiscal noise for the average citizen. It transforms the working class and middle class individual into a perpetual tenant of their own lifestyle, always a month behind their own ambitions. The resolution to this requires a structural shift in financial literacy, facilitated by technology. We are witnessing the rapid adoption of AI-driven equity visualisers. These are not the rudimentary budgeting spreadsheets of the past. They are sophisticated analytical tools that translate abstract interest rates into a tangible metric: the time to freedom ratio. By visually demonstrating how a minor high-interest purchase delays financial autonomy by weeks or months, these tools engage the logical, forward-planning centres of the brain. From the viewpoint of the consumer, it gamifies wealth building. From the viewpoint of the broader economy, it redirects capital from debt servicing into productive local investments. By 2026, this integration of technology and psychology is fostering a generation that values financial minimalism. The prestige of hollow, debt-funded ownership is being rapidly replaced by the far more sophisticated prestige of being entirely debt-free. We are building a society that calculates value not by what it can borrow, but by what it can retain. 2. The housing leverage paradox, the democratisation of fractional ownership. The traditional 30-year mortgage is increasingly viewed as an analogue relic operating in a high-speed digital economy. For the agile workforce, the prospect of being tethered to a single, massive, high-interest liability for 3 decades is a significant deterrent to professional and geographic mobility. Furthermore, as property values have outpaced wage growth, the barrier to entry has created a societal divide between the property-owning elite and a permanent renting class, fostering deep social resentment and economic fragility. The market is correcting this imbalance through fractional equity exchanges. Instead of a binary system where one must either take on crippling debt or pay rent that yields zero return, individuals can now purchase equity bricks. If a family can only afford to own 10% of their home, they purchase exactly that, whilst paying a proportionally reduced rent on the remainder. As their income grows, they buy more bricks. To the traditionalist, this may seem complex, but it fundamentally mimics the stock market, applying it to domestic shelter. It allows institutional investors to receive stable returns, whilst giving the common citizen a debt-free, incremental path to full home ownership. This model provides the psychological security of the hearth with the economic flexibility of the cloud. It ensures that shelter remains a foundational, wealth-generating asset for the masses, rather than a lifelong burden, effectively closing the wealth gap and granting families the mobility they require in a dynamic 21st century economy. 3. Education debt, the skills-based revolution and human capital. The legacy model of higher education has operated on a perilous assumption that an 18-year-old should absorb tens of thousands in debt for a degree with an unverified market value. This system has historically acted as a delayed start for our most brilliant minds. When young professionals enter the workforce burdened by immense monthly repayments, they are forced into risk-averse, purely survival-driven career paths. The broader societal impact is a catastrophic loss of entrepreneurial risk-taking and early career innovation, as intellect is subjugated by the immediate need for solvency. The pivot toward income share agreements and employer-sponsored microaccreditation is re-engineering this dynamic. In this modern model, the cost of education is treated precisely like a venture capital investment in human potential. Educational institutions or private funds cover the tuition. In return, they receive a small, fixed percentage of the student's future income for a set period, but only if that income surpasses a livable threshold. From the student's perspective, the risk of failure is shared. From the institution's perspective, there is a sudden, urgent mandate to ensure their curriculum actually aligns with high-paying, modern industry demands. This removes the debt at entry barrier entirely. Education is returning to its rightful place as a high-speed, high-return accelerator of human capital. By unburdening the next generation from the spectre of compound interest, we are unlocking an unprecedented wave of creative and intellectual potential. 4. Macro debt and the micro household, securing sovereign stability. National debt is frequently dismissed by the common citizen as an abstract macroeconomic figure, yet its consequences are deeply intimate. High sovereign debt manifests daily as inflation, currency devaluation, and the gradual erosion of public services. It acts as an invisible tax on every household, quietly diminishing purchasing power and eroding savings. When a government relies on perpetual borrowing to fund operational deficits, it forces its citizens to continuously out-earn inflation just to maintain a baseline standard of living. The forward-thinking nations of 2026 are adopting the golden rule of public equity, heavily influenced by the sovereign wealth fund models of Northern Europe, but applied at the municipal level. Rather than borrowing to patch societal leaks, public capital is aggressively directed into revenue-generating, high-yield infrastructure, such as municipal green hydrogen hubs, automated logistics networks, and local semiconductor clusters. This turns the state into an active, wealth-generating enterprise. The dividends from these sovereign assets are then used to offset local taxation and fund public services. We are witnessing a paradigm shift, where government efficiency and strategic asset-backed investment actively shield the household. When the state generates its own equity, it protects the individual citizen from the aggressive volatility of global bond markets, ensuring the nation acts as an economic fortress rather than a fragile debtor. 5. Energy debt, securing domestic equity and geopolitical peace. To live in a home reliant upon a volatile, fossil fuel-dependent national grid is to live in a perpetual state of energy debt. Households are at the mercy of global supply chains, international conflicts, and corporate price surges. This unpredictability creates a severe baseline anxiety for the working class, where a particularly cold winter can plunge a family into sudden financial distress. It is a fundamental lack of sovereignty at the kitchen table level. The 2026 transition to domestic energy equity is permanently severing this dependency. Through the strategic deployment of government grants for high-efficiency heat pumps, localised battery storage, and the broader integration of small modular reactors into regional grids, we are seeing the rise of the prosumer, the household that both consumes and produces power. By treating home energy upgrades not as an expense, but as a high-yield asset class, the mathematics change entirely. From an environmental viewpoint, it decarbonises the atmosphere. From a financial viewpoint, it fixes the cost of living. When a family no longer owes a fluctuating toll for their warmth or light, they successfully remove one of the largest recurring liabilities from their balance sheet. This energy independence provides a predictable, rock-solid baseline for all future financial planning, transforming the home into a self-sustaining sanctuary. 6. The psychological renaissance, cognitive clarity through autonomy. There is a profound, extensively documented correlation between the weight of financial debt and the suppression of human cognitive ability. Chronic financial stress acts as a literal cognitive tax. Neuroscientific studies in the mid-2020s demonstrated that operating under the constant threat of debt servicing elevates cortisol levels, severely diminishing a person's working memory, executive function, and capacity for long-term planning. It forces the brain into a state of tunnel vision, where individuals can only focus on surviving the immediate month, rendering them incapable of engaging in complex strategic thought about their future or their community. The societal shift toward an equity-first lifestyle is sparking a literal mental health renaissance. By addressing the root cause, financial precarity, rather than merely treating the symptoms of stress, individuals are reclaiming their cognitive bandwidth. The Living Free initiative promotes the philosophical understanding that true wealth is measured strictly by the absence of obligation. It requires a societal reprogramming to view the decluttering of liabilities as the ultimate status symbol. As individuals reclaim their minds from the debt service cycle, we are observing an extraordinary explosion in community engagement, civic participation, and deep focus intellectual work. The psychological clarity and intellectual reasoning gained from operating from a position of zero liability is perhaps the most valuable, transformative dividend of this new economic era. 7. Lean innovation, entrepreneurship without the bank. In the old-style industrial thinking, initiating a business required a massive upfront capital expenditure, usually facilitated by a high-interest commercial bank loan. This created an insurmountable barrier to entry for millions of brilliant minds who lacked collateral. Furthermore, it created a culture of fear. The high stakes of debt repayment meant that entrepreneurs were terrified of failure, leading to safe, iterative businesses rather than bold, paradigm-shifting innovations. The cost of failure was simply too high. Today, the convergence of digital regulatory sandboxes and decentralized finance has thoroughly democratized the leap into entrepreneurship. Modern innovators are utilizing lean, digital-first operational models to test their hypotheses in the real market at a fraction of the historical cost. When capital is required, they turn to community-backed equity, micro-investing platforms, and tokenized funding. From the perspective of the investor, risk is distributed. From the perspective of the founder, they surrender a portion of future profit rather than taking on a rigid monthly debt obligation. This structural change ensures that a business failure is a data point and a learning experience, not a catastrophic bankruptcy. It fosters a culture of high-speed experimentation, where the ultimate arbiter of success is the quality of the intellectual capital and the resilience of the idea, completely unburdened by the heavy hand of traditional banking. 8. The multi-generational equity bridge, building sustainable legacies. Historically, the transfer of wealth between generations was fraught with inefficiency. Estates were often passed down as a complex, entangled web of illiquid assets, depreciating physical goods and lingering liabilities. In a rapidly fluctuating market, inheriting a large, outdated property with a remaining mortgage and high maintenance costs could actually plunge the heir into a cash flow crisis, turning a supposed gift into a financial anchor. The modern approach to family wealth focuses on the compounding green legacy. We are seeing a massive reallocation of generational wealth from static, debt-heavy assets into highly liquid, growth-oriented equity sectors. Parents and grandparents are deliberately structuring trusts around biotechnology indices, AI infrastructure, and renewable energy portfolios. This requires a shift in reasoning. Understanding that a share in a quantum computing firm or a wind farm provides infinitely more agility and compounding value to the next generation than an aging suburban manor. By deliberately shifting to future-forward equity, families are actively securing a prosperous launchpad for their children rather than a safety net tangled in debt. This ensures that each successive generation begins further ahead, equipped with the agile capital required to contribute meaningfully to a rapidly evolving world. 9. Innovative living, the agile household and the death of isolation. The 20th century ideal of the sprawling, debt-heavy suburban home isolated families and enforced a rigid, car-dependent lifestyle. It forced individuals to anchor themselves to a specific geographic location, often hours away from cultural and economic hubs, simply to afford the mortgage. This model is incredibly inefficient for the modern, remote-working professional, leading to severe lifestyle inflation and an epidemic of suburban isolation, where community connection is sacrificed for square footage. The 2026 professional values access and community far above isolated possession. The rise of managed living hubs provides a highly sophisticated, structurally sound alternative. These premium, tech-integrated living spaces operate on equity membership models. A resident's monthly payment covers their private quarters, access to world-class communal amenities and, crucially, contributes to a diversified equity stake in the broader property portfolio of the hub network. Sociologically, it reintroduces the village concept to the modern metropolis, combating isolation. Economically, it allows a professional to live in London for 6 months and Tokyo for the next, seamlessly transferring their membership whilst their equity continues to compound. This agile household approach liberates the individual from the physical and financial stagnation of the old world mortgage. It allows humanity to follow opportunity, culture, and connection across the globe, secure in the knowledge that they are perpetually invested in the infrastructure of the future. 10. The ultimate perspective: equity as the architecture of freedom. Ultimately, the most profound problem we face is a philosophical one. For over a century, the global population has been meticulously conditioned by marketing and financial institutions to believe that credit is king. We have been trained to measure our self-worth and societal success by our capacity to borrow, to live in homes, drive vehicles, and wear clothes that we do not truly own. This has resulted in a society that is superficially rich in material possessions, but desperately impoverished in time, autonomy, and peace of mind. The transition from debt to equity requires a fundamental architectural perspective shift. At World Perspective, we recognise that equity is not merely a financial term, it is the ultimate high-tech lifestyle. It is the conscious decision to step off the treadmill of perpetual repayment. When we dissect the psychology of wealth, we realise that the most valuable commodity any human possesses is their finite time on this earth. By choosing to transition from owing to owning, whether that is fractional property, sovereign energy, or simply living below our means to buy back our time, we regain absolute control over our daily existence. As we move deeper into the 21st century, the deliberate transition from a debt-based society to an equity-based one represents a profound liberation of the human spirit. It is the realization that true prosperity is not about how much we can acquire, but how completely we can design our own destiny. Conclusion: financial tools for the future. As we look toward the horizon of the late 2020s, the global movement from debt to equity appears less like a fleeting financial trend and more like a permanent evolutionary leap in human society. We are actively engineering a world that is fundamentally more resilient. The household is no longer a vulnerable, easily manipulated node in a fragile web of global credit. It is becoming a secure, self-sustaining fortress of personal sovereignty. The innovative models we have explored today, from fractional real estate and energy independence to income sharing and decentralized innovation, are not abstract economic theories. They are the practical, accessible tools of a new liberation. By choosing to build equity rather than borrow from our own futures, we are fostering a global community that is bolder in its ambitions, more creative in its endeavours, and profoundly optimistic about its trajectory. This is the dawn of the free citizen, an era where the prosperity of our nations is measured not by the volume of our debt, but by the unshakable depth of our equity. If the heavy burden of your current financial obligations were to completely vanish tomorrow, replaced by a secure, compounding foundation of equity, what is the one great, creative contribution you would finally have the freedom to give to the world?